Disclaimer.
Hello, it's AG. I'm making my comeback. Yesterday, another avatar replaced me, but clearly you prefer me. I'm very touched that you prefer my beautiful white shirt. Anyway, what happened yesterday was incredible, wasn't it? 2 days ago, on January 29th, the silver market did something impossible. It hit a record $122.46, completing a 300% surge that had every retail investor on Earth screaming FOMO. Then, in the last 48 hours, the floor collapsed. Silver didn't just correct, it cratered 30%, dragging gold down from $5,600 to below $5,000 in the most violent liquidation event in modern financial history. The media says it's over. They're telling you the worst shock and a surging dollar just killed the bull run. But while they're watching the price on your screen, they're ignoring the 8% lease rates in London and the 33 million ounces that just vanished from the COMEX vaults. This isn't a crash, it's a banking trap. And if you sell your physical metal into this reversal, you're handing your wealth directly to the institutions that just ran out of liquidity. Today, we go behind the headlines to show you why the system just hit a $0 liquidity wall and why $150 silver is on an if, but a mathematical certainty of our new 2026 reality. Here's what you need to understand about what just happened. While everyone's watching price charts, something far more significant is unfolding behind the scenes. For those of you who don't track commodities markets daily, let me put those 8% lease rates in perspective. A lease rate is what someone pays to borrow physical metal. Under normal conditions, borrowing silver costs almost nothing because there's supposedly plenty of supply sitting in vaults around the world. The typical range is 0.3 to 0.5%, but when lease rates suddenly spike to 16 times their normal level, it's screaming one thing. Someone desperately needs physical metal and can't find enough of it. You don't pay 8% to borrow something that's abundant and unwanted. You pay 8% when you're in a squeeze and have no other options. Now let me show you the pattern most people are missing. While silver's price was crashing on paper, the physical market was telling a completely different story. Dealers were reporting premiums on physical silver bars and coins staying elevated even as futures prices plunged. Online retailers couldn't keep 1 kilogram bars in stock. Mints around the world were running behind on orders. The disconnect between what was happening on trading screens and what was happening at coin shops across America couldn't have been more stark. Think about the last time you saw this pattern play out. In March 2020, when markets crashed during the first COVID panic, investors who tried to buy physical gold and silver discovered something deeply unsettling. Premiums on coins and small bars exploded to 30, 40, even 50% above the official spot price you'd see on financial websites. Dealers were completely out of stock. Delivery times stretched from days to months. If you called your local coin shop, they'd laugh at the idea of selling you silver anywhere near spot price. The paper price said metals were cheap and plentiful, but try actually buying some and you'd face a very different reality. That disconnect lasted for weeks before the paper market finally caught up and prices surged to reflect the physical shortage. But here's what's different this time. In March 2020, the shortage was driven by retail panic buying. Regular Americans were worried about the pandemic and wanted hard assets. This time, the demand is coming from institutions, sovereign wealth funds, and central banks. These aren't emotional retail traders who will sell back when they calm down. These are strategic buyers who are repositioning for a fundamental shift in the global monetary system. We're watching that same fracture open up again, except this time the gap is widening faster, the players are bigger, and the systemic implications run deeper. The paper market for silver, where banks and hedge funds trade contracts representing hundreds of millions of ounces, has always operated on one simple assumption. Most contracts will never demand physical delivery. It's like a poker game, where everyone knows most chips will never be cashed in. The house can keep the game going as long as players stay in their seats and keep betting with chips. But what happens when the big players start demanding their chips be converted to actual cash? What happens when sovereign buyers and strategic institutions decide they'd rather hold metal in their own vaults than paper promises from New York banks? The numbers reveal why this matters so much. According to market analysts tracking the silver derivatives market, the notional paper-to-physical ratio has reached staggering levels, with some estimates putting it above 300 to 1. That means for every ounce of actual silver sitting in a vault somewhere, there are 300 paper claims on that same ounce circulating through the financial system. As long as only a tiny fraction of those claims ever demand physical delivery, the system works fine. Everyone can pretend the emperor has clothes. But here's what happens when that fraction starts growing. The withdrawals from COMEX vaults aren't random noise or seasonal fluctuations. They're sustained, aggressive, and accelerating. When 33 million ounces disappear in a single week while the price is crashing, you're watching sophisticated players make a calculated bet. They're betting that paper claims will become worthless and physical possession will be everything. They're front-running the moment when the music stops and there aren't enough chairs. The 8% lease rates confirm this thesis from a different angle. When borrowing costs spike that dramatically, it's not because lenders are greedy, it's because they're terrified. They're looking at their inventory, doing the math on outstanding contracts, and realizing they might not have enough metal to meet their obligations. So they're charging insurance policy rates to anyone who wants to borrow, because they know returning that metal could become impossible. You're probably asking yourself, if there's such a massive shortage of physical silver, why did the price just crash? The answer reveals how disconnected our financial markets have become from physical reality. The price you see on your screen isn't set by someone walking into a shop and buying a silver coin. It's set by massive institutions, trading contracts in milliseconds, algorithms responding to headlines, and leveraged positions being forcibly unwound regardless of fundamentals. When the dollar surged on the Warsh nomination, every commodity priced in dollars faced immediate pressure. Silver, with its smaller market size and thinner liquidity compared to gold, got hit especially hard. Leveraged traders who'd bet big on silver's rise suddenly faced margin calls. They had to sell, period. The algorithm saw the selling and piled on. Within hours, what started as a rational market adjustment had turned into a liquidation cascade that bore no relationship to actual supply and demand. But notice what didn't change during those 48 hours. The industrial demand for silver didn't evaporate. The solar panel manufacturers didn't suddenly find a substitute. The electric vehicle producers didn't stop needing the metal. The central banks in Asia and the Middle East didn't reverse their diversification strategies away from dollars. All the fundamental forces pushing silver higher remained intact, even as the price was getting demolished on trading screens. This is the critical point most analysts are missing in their rush to explain the crash. They are treating it as the end of silver's bull market when it's actually revealing the fragility of the entire paper system. The banks that control the futures market just showed their hand. They can still manipulate prices in the short term, but they can't conjure physical metal out of thin air. And that's the liquidity wall we just hit. The question every American with savings or investments needs to be asking right now isn't whether Friday's crash was justified by technical analysis or margin call narratives. The question is, what happens when institutions that sold paper, promises at $122, suddenly need to deliver actual metal at $84 and discover there isn't enough to go around? Because if those 48 hours taught us anything, it's that the paper market can still create violent price swings even when the physical market is screaming shortage. And that should concern you far more than any single day's price action. The banking trap isn't closing, it's just getting started. Now let's talk about Kevin Warsh, because his nomination as the next Federal Reserve Chair isn't just another political appointment. It's a signal flare revealing the chaos unfolding at the highest levels of American monetary policy. And if you understand what it means, you'll see why the crash we just witnessed was inevitable and why the next move higher could be even more explosive than the run to $122. Here's what most people don't know about Warsh. During the 2008 financial crisis, when he was the youngest Federal Reserve governor in history, he warned aggressively about inflation that never actually materialized. From 2008 through 2011, while unemployment hovered near 10% and millions of Americans were losing their homes, Warsh was sounding alarms about runaway price increases that simply didn't happen. He pushed for tighter monetary policy at exactly the moment the economy needed support. Think about that track record for a moment. Now, fast forward to today, and President Trump has nominated the same person to lead the Fed, but with a completely different mandate. Trump expects aggressive rate cuts to stimulate the economy and support his policy agenda. You're looking at a Fed chair nominee whose historical instincts run directly counter to what the president who nominated him actually wants. It's like hiring a vegetarian to run your steakhouse. But the story gets even stranger when you look at what's happening in the Senate. Republican Senator Thom Tillis and others are threatening to block Warsh's confirmation until the Department of Justice resolves its criminal investigation of current Fed Chair Jerome Powell. Let me repeat that, because it's worth letting sink in. We have a sitting Federal Reserve chairman under criminal investigation, while the president who wants him gone has nominated a replacement that key senators might block for unrelated political reasons. This isn't normal political theater. This is an unprecedented crisis in Federal Reserve independence at precisely the moment when our monetary system is facing its biggest external challenges since the Bretton Woods collapse. The institution that's supposed to anchor global confidence in the dollar is caught in a political crossfire, and nobody seems particularly worried about what message this sends to foreign central banks and sovereign wealth funds watching from Beijing, Riyadh, and Moscow. Which brings us to the dollar itself, because while Americans have been focused on silver's price swings and Fed politics, something far more consequential has been unfolding in currency markets. The dollar index fell to 95.5 in January, hitting levels we haven't seen since February 2022. That's nearly a 4-year low, and it's accelerating. You might be thinking, so what? The dollar goes up and down all the time. But let me show you what's different this time. According to data from global central banks, they net sold $48 billion in reserves during January alone. That's not portfolio rebalancing or routine diversification. That is a coordinated move away from dollar holdings by the very institutions that have propped up our currency for decades. The dollar's share of global reserves has now fallen to 58.2%. That might not sound dramatic until you realize this is the lowest level since 1995. We're talking about 3 decades of dollar dominance being unwound in real time. Every month that goes by, central banks around the world are making a calculated decision that holding dollars is less attractive than the alternatives, whether that's gold, euros, yuan, or increasingly actual commodities. And here's where it connects directly to what happened with silver. When the dollar surged on the Warsh nomination news, it created a temporary headwind for commodities priced in dollars, but that surge was happening against a backdrop of structural dollar weakness that isn't going away. The fundamentals driving de-dollarization didn't change because of one news headline. They're locked in by decades of policy choices, mounting debt levels, and geopolitical shifts that no Fed chair nomination can reverse. The BRICS nations just announced they are increasing internal trade settlement in local currencies from 35% to 50%. Think about what that means. The world's fastest growing major economies are systematically reducing their need for dollars in international commerce. Every barrel of oil traded between Russia and India without dollars, every manufacturing component sold from China to Brazil in yuan or reais rather than greenbacks, these are not reversible trends. They're structural shifts in the architecture of global trade. ASEAN countries are planning a regional unified payment system by 2027 that will further reduce dollar dependency in Southeast Asia. The European Union is pushing for more euro-denominated trade with Africa and the Middle East. Even traditional American allies are quietly hedging their bets, increasing gold reserves, and exploring alternatives to dollar-based settlement systems. Now, let's connect this back to silver because this is where the paper market illusion becomes impossible to sustain. Remember that 300 to 1 paper to physical ratio I mentioned? Some analysts tracking the derivatives market are putting the actual ratio even higher. There are credible estimates suggesting the ratio peaked at 356 to 1 during the surge to $122. Imagine you are running a bank that sold hundreds of millions of ounces worth of paper silver contracts. You've collected premiums, you've made trading profits, and everything works fine as long as nobody demands physical delivery. But now the dollar is weakening structurally, geopolitical tensions are rising, and sophisticated buyers are demanding actual metal instead of paper promises. What do? You try to shake out the weak hands. You trigger a liquidation event that scares retail investors into selling their physical holdings back to you at lower prices. You use your control over the futures market to create a price crash that looks like the bull run is over, hoping that panicked sellers will provide you with the physical metal you desperately need to cover your positions. This is why those 8% lease rates matter so much. In a normal market, you'd never see borrowing costs spike like that unless there was genuine physical shortage. But when you combine unprecedented lease rates with massive inventory withdrawals and a price crash, you're watching a squeeze play out in real time. The institutions that control the paper market are simultaneously trying to suppress prices while scrambling to secure physical metal. According to market data, physical silver demand surged over 500% since late 2025 for 1 kilogram bars specifically. That's not a typo. We're not talking about a 20 or 30% increase in retail interest. We're talking about demand quintupling for the most popular investment bar size. Mints can't keep up, dealers are running waiting lists, and premiums are staying elevated even as the paper price crashes. Here's what that tells us. The people buying physical silver right now aren't momentum traders chasing a quick profit. They are strategic buyers who understand the difference between owning a contract that promises silver and owning actual metal in a vault. They're looking at the same data we're discussing. The Fed in crisis, the dollar in structural decline, central banks dumping reserves, paper markets with hundreds of claims per physical ounce, and they're making a calculated bet that physical possession will be worth far more than paper promises when this system breaks. And make no mistake, the system is breaking. When a sitting Fed chair is under criminal investigation, when the nominee to replace him has a track record that contradicts what the president wants, when global central banks are selling dollars at record pace, when silver lease rates hit 16 times normal levels while prices crash, these aren't isolated data points. They're symptoms of a monetary system in terminal decline. You're watching the slow motion collapse of the post-1971 fiat currency experiment. The Bretton Woods system that pegged the dollar to gold lasted from 1944 to 1971, just 27 years. The pure fiat system that replaced it is now 54 years old and showing every sign of age. Cracks are appearing everywhere, from Fed independence under assault to dollar reserves being dumped to physical commodity markets decoupling from paper prices. The question isn't whether the system will hold. The question is, what happens to your wealth when it doesn't? Because every dollar you hold in a bank account, every treasury bond in your portfolio, every paper asset denominated in a currency that's losing global reserve status, all of it is a claim on a system that's running out of credibility. The institutions running that system just showed you their playbook. They can still create violent price swings in paper markets. They can still trigger margin calls and forced liquidations. They can still scare retail investors into panic selling. But what they can't do anymore is conjure physical metal out of thin air or restore confidence in a dollar system that's being systematically dismantled by America as rivals and increasingly questioned by our allies. So when you see silver crash 30% in 48 hours, don't just look at the price, look at the lease rates, look at the vault withdrawals, look at the dollar's structural decline, look at the Fed in crisis, look at central banks dumping reserves, look at the paper to physical ratio, and ask yourself, which side of this trade do you want to be on when the music finally stops? Let's do some math that your financial advisor probably won't show you. Because while everyone's debating whether silver's bull run is over, there's a calculation unfolding that makes the next move almost mathematically inevitable. And it starts with something most Americans are already feeling in their wallets but haven't connected to the precious metals market: tariff inflation. The numbers are already locked in. According to economic analysis, tariffs will impose an average tax increase per U.S. household of $1,000 in 2025. That's not a projection or a worst-case scenario. That's what's already baked into the system based on current policy. And it gets worse in 2026, when the average household burden increases to $1,300. The weighted average applied tariff rate on all imports has risen to 14.0%. Let that sink in for a moment. We're now running the highest tariff regime since 1946. You'd have to go back almost 8 decades to find a period when American trade policy was this protectionist. And whether you think tariffs are good economic policy or not, there's one undeniable consequence. They create inflation that can't be wished away by Fed policy or political rhetoric. American families paid an extra $2,120 for goods and services in 2025. That's money coming directly out of your purchasing power, your savings, your retirement plans. And it's not temporary. These aren't one-time adjustment costs. This is structural inflation embedded into our economy for as long as the tariff policy remains in place. Now here's where this connects to silver. Inflation is supposed to be the death of fiat currencies and the best friend of hard assets. When the purchasing power of your dollars is eroding by design, smart money moves into things that can't be printed by central banks or devalued by trade policy. Gold, silver, real estate, commodities. These are the traditional inflation hedges that have protected wealth through every currency crisis in human history. But we just watched silver crash 30% while tariff inflation is locked in and accelerating. How does that make sense? It doesn't, unless you understand that we're watching two different markets tell two different stories. The paper market can be manipulated in the short term by leveraged selling and forced liquidations. The physical market follows the laws of supply and demand that no algorithm can override. Let me show you why this matters. During the crash, from $122, the gold to silver ratio spiked above 60 to 1. For those unfamiliar with this metric, it measures how many ounces of silver it takes to buy 1 ounce of gold. Historically, this ratio has averaged somewhere between 15 to 1 and 20 to 1, based on the relative abundance of these metals in the earth, its crust, and their industrial versus monetary demand. When the ratio hits 60 to 1, it's telling you that silver is extremely undervalued relative to gold. It's happened before during major market dislocations, and every single time, the ratio eventually reverts back toward its historical mean. The question isn't whether mean reversion will happen. The question is how violently it occurs and whether you positioned yourself to benefit from it. JP Morgan's Marko Kolanovic, one of Wall Street's most prominent strategists, recently warned that silver could crash all the way to $50. He's looking at historical patterns, technical indicators, and the severity of leveraged positioning that built up during the run to $122. From a pure chart analysis perspective, his bearish case has merit. Markets often overshoot in both directions, and $50 wouldn't be unprecedented if we're seeing a full unwinding of speculative excess. But here's what Kolanovic and the bearish analysts are missing. This time actually is different, and not in the usual delusional way that phrase gets thrown around before every market crash. This time is different because the structural factors supporting silver demand have fundamentally changed from previous cycles. Solar panel manufacturing is consuming silver at unprecedented rates, and unlike previous industrial uses, this demand is accelerating rather than moderating. Every major economy has committed to renewable energy targets that require massive solar installations over the next decade. China alone is planning solar capacity additions that will require hundreds of millions of ounces of silver. You can't just substitute copper or aluminum for silver in solar applications without significant efficiency losses. The physics doesn't change because prices went up. Electrification of vehicles is adding another structural demand source that didn't exist in previous silver bull markets. Every electric vehicle uses significantly more silver than traditional cars due to extensive wiring, battery connections, and charging infrastructure. As the global auto fleet transitions from internal combustion to electric power, silver demand from this sector will multiply several times over. This isn't speculative future demand. This is locked-in consumption based on vehicles already in production pipelines and government mandates requiring EV adoption. The bulls arguing that this time is different aren't relying on hopium or wishful thinking. They're pointing to fundamental supply-demand imbalances that didn't exist during previous silver cycles. Global silver mining production has been essentially flat for years, while industrial consumption keeps growing. The above-ground stockpiles that could buffer temporary shortages have been drawn down. And unlike gold, which mostly gets recycled and accumulated, silver gets consumed in industrial applications where recovery is economically impractical. Despite the violent correction from $122, silver remained on track for a monthly gain of more than 30% as of late January. Think about that for a moment. The metal just experienced one of its most violent sell-offs in history, and it's still up 30% for the month. That's not the behavior of an asset in a bear market. That's the behavior of an asset in a structural bull market experiencing temporary disruptions. Now let's talk about what happens next, because we're approaching a convergence point that will force a resolution one way or another. On one side, you have de-dollarization accelerating at a pace that would have seemed impossible just 5 years ago. ASEAN nations are planning a regional unified payment system by 2027 that will reduce their dollar dependency by an estimated 40%. That's not anti-American rhetoric or conspiracy theory. That's official policy being implemented by some of our most important trading partners. The European Union is pushing for more euro-denominated commodity trading. Middle Eastern oil producers are accepting yuan and other currencies for crude sales. Russia and China have almost completely eliminated the dollar from bilateral trade. India is buying Russian oil in rupees and UAE dirhams. Brazil is settling trade with China in reais and yuan. Every month brings new announcements of major trading relationships moving away from dollar settlement. This matters because every dollar not needed for international trade is a dollar that loses a piece of its value proposition. The dollar's strength has always been rooted in its necessity for global commerce. If you wanted to buy oil, you needed dollars. If you wanted to trade with America or American allies, you needed dollars. That necessity created structural demand that supported the dollar's value regardless of our debt levels or monetary policy. But when that necessity disappears, when major economies can trade with each other without touching the dollar, the entire foundation shifts. And we're not talking about something that might happen in 20 years. We're talking about infrastructure being built right now, payment systems going live within the next 2 years, and trading relationships actively diversifying away from dollar dependence. On the other side of this convergence, you have unprecedented turmoil around the Federal Reserve, a sitting chair under criminal investigation, a nominee whose track record contradicts what the president wants, senators threatening to block confirmations over unrelated political disputes. The institution that's supposed to anchor global confidence in American monetary policy has become a political football at precisely the wrong moment. Foreign central banks and sovereign wealth funds are watching this circus and making calculated decisions about their reserve holdings. Every week of chaos at the Fed is another week where holding dollars looks less attractive and holding hard assets looks more prudent. These aren't emotional decisions driven by headlines. These are strategic repositioning moves by sophisticated institutions managing trillions of dollars. And in the middle of all this, silver is finding technical support right around the 50-day exponential moving average near $70.81. For traders watching the charts, this level represents a critical battleground. Hold above it, and the bull market remains intact despite the violent correction. Break below it, and we could see that move down to $50 that the bears are predicting. But here's what you need to understand about technical analysis in markets experiencing structural shifts. The charts can tell you where support and resistance levels are, where traders will likely make decisions, where stop losses are clustered. What the charts can't tell you is what happens when physical shortage meets paper market breakdown. They can't tell you what happens when lease rates stay at 8% for weeks instead of days. They can't tell you what happens when COMEX registered inventory keeps draining regardless of price. Technical analysis works beautifully in normal markets where the rules stay consistent. But we're not in a normal market anymore. We're in a market where the paper-to-physical ratio has reached 356 to 1, where central banks are dumping $48 billion in dollar reserves per month, where the Fed's independence is under assault, where tariff inflation is locked in at 14%, and where sovereign nations are building payment systems specifically designed to avoid using our currency. In this environment, you're facing a binary choice that will define your financial outcome over the next several years. On one hand, you can hold dollars that are mathematically guaranteed to lose at least 1.3% of their purchasing power annually, just from tariff inflation alone. And that's before accounting for all the other inflationary pressures building in the system. Your dollars will buy less next year than they do today, and even less the year after that. On the other hand, you can position in hard assets before the next leg up, when paper market credibility fully breaks and the physical shortage becomes impossible to deny. You can be on the side of the trade that benefits when institutions that sold paper silver at $122 suddenly need to deliver actual metal at current prices and discover there isn't enough to go around. This isn't about getting rich quick or timing a perfect market bottom. This is about understanding that we're living through a once-in-a-generation shift in the global monetary system, and the assets you choose to hold during this transition will determine whether you preserve your purchasing power or watch it erode in a currency that's losing its privileged status. The crash to $76 through $84, that just happened? That's not the end of the story. That's the banking institutions showing you they can still manipulate paper prices in the short term while they scramble to cover their physical shortage in private. That's the forced liquidation of leveraged traders who bet big and got stopped out. That's the algorithm-driven selling that creates opportunity for those who understand the difference between price and value. Because here's the ultimate calculation that makes $150 silver not an if, but a mathematical certainty in our new 2026 reality. You have structural inflation locked in by tariff policy. You have industrial demand accelerating from solar and electrification. You have investment demand surging as trust in paper assets erodes. You have global de-dollarization reducing the need for dollars. You have a Fed in crisis, unable to provide monetary policy certainty. You have central banks actively buying gold and dumping dollar reserves. And you have a paper market for silver that is leveraged 356 to 1 against physical inventory that's draining at record pace. Every one of those factors points in the same direction. The only question is whether you will be positioned on the right side when the convergence point arrives and the market resolves the disconnect between paper promises and physical reality. The 48 hours from January 29th to January 30th showed us the banking trap in action. They crashed the price to shake out weak hands while their lease rates screamed physical shortage. They forced liquidations to suppress the rally while their vaults emptied at record speed. They convinced retail investors the bull run was over, while institutional buyers quietly accumulated physical metal. Don't take the bait. The trap isn't closing. It's about to spring on those who set it. And when it does, $150 silver won't look like a target. It'll look like a footnote on the way to wherever this system breakdown ultimately takes us.